Welcome to This Explainer. Today, we're diving into the ultimate business mystery. How on earth can a company with sky-high sales and record profits still run completely out of money? It's one of the most maddening situations you can face as a business owner. I mean, if the company's making money, shouldn't there literally be money in the bank? So, let's play financial detective and walk through the CEO's guide to liquid assets.
All right, let's just jump right into this massive paradox. You look at your financials, sales are up, customers are grabbing your products left and right. On paper, the business is incredibly profitable. And yet, you check the bank balance at the end of the month and you're staring at it, asking the exact same panicked question. Where did all the cash go? It just doesn't make sense, right? Well, to crack this case, we have to debunk a really dangerous misconception right out of the gate. Profits does not automatically equal cash. Accounting profit and actual physical cash movement, those are two completely different things. You can absolutely post a massive profit while your actual usable cash is tied up somewhere else entirely. Getting a handle on this separation is literally one of the most important things you can do as a CEO. Which brings us to Section 1, the Great Profit Illusion, where we'll see how growth actually consumes cash. Picture this. You've got a company pulling in $10 million in sales, reporting a really solid $1 million in net profit. Now, logically, you'd expect an extra $1 million just sitting comfortably in your checking account, right? But more often than not, you won't see a single extra peso. And this is the ultimate irony of scaling a business. The faster you grow, the more likely you are to face a total cash crunch. Why? Because growth eats cash. When you scale up, you're usually funding that growth right out of your own pocket, way before those on-paper profits turn into liquid cash. So where is the money hiding? Let's look at Section 2, Suspect 1, Unpaid Invoices. To figure out where your cash gets trapped, we have to interrogate our prime suspects. Let's go back to that $10 million in sales. Imagine $2 million of that is still unpaid by your customers. From an accounting standpoint, you made the sale, you recorded the revenue, and hey, you technically earned the profit. But if that $2 million is just sitting in accounts receivable, your customer still has your money. Basically, your business is acting as a free bank, financing your customers. So if your sales jump to $20 million, but your clients start taking longer to pay, your profit is going to look amazing, but your bank account will be totally empty. Moving on to Section 3, Suspect 2, Trapped Inventory. Leaving the customer's wallet, we head straight to your warehouse. Say you're gearing up for a big sales push, so you load up on raw materials and pack your shelves with product. On paper, you didn't take an immediate expense for all that. You just converted a cash asset into an inventory asset. You might look out at your warehouse floor and see $5 million worth of valuable stuff. But here's the harsh reality. You absolutely cannot pay your employees with boxes of unsold product. You can't pay your rents or your taxes with slow-moving inventory. It's valuable, for sure, but it is not liquid cash. Now for Section 4, Suspect 3, Debt Repayments. The third place your cash likes to hide is in borrowing and long-term commitments. Look, when you take out a 3 million pesos loan, your bank balance shoots up, but you didn't earn that money, and eventually that principal has to be paid back, usually with interest. Even if your day-to-day operations are highly profitable, a huge chunk of your cash is constantly being drained by these hidden cash eaters. We're talking loan repayments, buying new equipment, facility renovations, or even owners just taking cash draws. So if the answer isn't that the business lost money, but that it just used the money somewhere else, how do we actually track it? To get the full truth, a financially disciplined CEO knows that just looking at the income statement is a fatal mistake. You really have to look at 3 different clues, because the 3 major financial statements answer entirely different questions. First step is the income statement. This answers a very specific question. Did we make a profit? And look, it's a fantastic tool. It tells you all about your revenue, expenses, and profitability over a set period of time. It proves whether the fundamental economics of your product actually makes sense. But it absolutely does not tell you if you can make payroll tomorrow. Next, we have the balance sheet. This one answers, what do we own, what do we owe, and what is left for the owners. It gives you a snapshot of your assets, liabilities, and equity at one single point in time. It's great for checking how much inventory you have or how much debt you're carrying, but again, it's just a static photograph of a constantly moving business. Which brings us to the crucial piece of the puzzle, the cash flow statement. This answers the most vital question of our whole investigation. Where did the cash actually come from, and where did it go?
Seriously, if you're a business owner tossing and turning over your bank balance, this statement is your absolute best friend. It tracks the actual physical movement of money in and out of your doors.
Let's put this into practice in Section 5, the crime scene, walking through the monthly mouth. To really hammer this home, let's step onto the crime scene and do the math that proves profit doesn't equal cash. Let's say you started the month with 2 million pesos in cash. Nice. You collected a solid 5 million pesos from customers, you paid suppliers 3 million pesos, and your operations and salaries cost you 1 million pesos. Right now, your business is operating at a profit. But then you bought 1.5 million in new equipment to keep growing, and you had to make a 500,000 peso loan repayment. So despite being incredibly profitable on paper, your actual ending cash dropped from 2 million pesos down to 1 million pesos. The growth in the debt literally consumed your liquid assets. So how do we fix this? Let's look at Section 6, the CEO Cash Flow Guide. Now that we've solved the mystery of the missing money, how do you make sure it doesn't happen again? How do you keep that financial breathing room? Well, you have to stop asking just, are we profitable, and start running through this specific checklist of liquid assets every single day. 1. How much cash do we literally have on hand today? 2. How much money do customers still owe us, and how fast are we actually collecting it? 3. How much cash is locked up in warehouse inventory? And 4, what do we owe our suppliers and what debt payments are coming up? But you can't just obsess over today. The absolute most vital question you can ask your finance team is this: how much cash are we going to need over the next 30, 60, and 90 days? Asking this completely shifts your mindset. Instead of looking backward at an income statement to see what happened, you're actively projecting what's coming next. It lets you spot those cash traps before you fall headfirst into them. Here is the core philosophy you've got to take away from this. We aren't saying profit is bad. A profitable, growing business is amazing. Profit tells you that you've created economic value. It proves your business model actually works. But cash flow? Cash flow is financial oxygen. It's what keeps the business breathing. And if you run out of oxygen, it really doesn't matter how brilliant your underlying business model is. By all means, celebrate your profitability, but always remember, profit tells you the business works, but cash flow dictates whether it survives. So the next time you're looking at growing sales, ask yourself this one final critical question. Is your highly profitable business secretly on the verge of going broke? Thanks for joining me for this explainer. Now, go find your missing cash.